Our distinguished panelists today are some market movers in the venture community. I'm Dimitri Argas. I'm with SomaSense Insight, based in San Diego, California. We're a connected health consultancy. And what I'd like to do is begin with a couple questions. But before I begin with the questions, I'd like to poll the audience in terms of how many folks in the audience here are entrepreneurs? How many folks are engineering type / hoodies? Yeah. All right. Any VCs or anyone else? All right. So on our panel today we have Evangelos, Jeb, Savitha, and Tarun. And if you'd like, start with Evangelos, give a little background, and also kind of what your investor thesis, areas of focus are.
So good afternoon. Evangelos Mouris, I'm a managing director over at Trident Capital. Trident is a growth stage private equity firm with a little bit of venture capital these days. We manage $2 billion. We invest in software, internet, and tech-enabled services in North American companies. Since our inception 20 years ago, we have been investing in data-driven companies, data-driven software companies. These days, a lot of our investments are in applications, cloud-based, data-driven applications, as well as security and healthcare IT, based in Palo Alto. I've been with the firm for 9 years now. Prior to that, I was a general partner at Apex Partners, private equity firm based out of New York. And before that, for about 20 years, I was in operations with a very heavy data analytics work. Got 2 startups all around the area of analytics and data warehousing. And between the two, I was general manager at IBM's
Hi, my name is Jeb Miller. I'm a partner with a venture firm called Javco Ventures. That's Japanese for big data, which is why I'm on this panel. I don't know if we're market movers, but we have heavy concentration of our building in Hamilton Avenue. We're based upstairs from Trade. We have been active for about 10 years. Our strategy is to be a Series B stage specialist, so we invest in companies right around the time when they're coming to market. Big data and data analytics and infrastructure has been a very heavy focus for us. We had a great run of success with the infrastructure layer with investments in companies like Datalegro, which we sold to Microsoft, and Asset Data, which we sold to Teradata, Delphix, and lately we've been spending a lot of time looking at the application of distributed data to solving analytics and business challenges at a vertical and horizontal layer of the IT stack.
Hi everyone, I'm Savitha Srinivasan, partner and director of strategy in IBM's venture capital group. So as I was just telling Jeff, let me date myself. This is my 22nd year right after grad school at IBM. And people often ask me, how do you manage to do that? Living in Silicon Valley, how do you stay with IBM that long? So short answer to remain to this panel is, I grew up in data. So sort of all my early years was spent at the T.J. Watson Research Center, working on some of the early data science algorithms there. And then I slowly moved westward to the Almaden Research Lab, continued to work on information management, data mining, content management technologies that research was delivering to the product group that Evangelos was once part of. And more recently, over the last 4 to 5 years, I'm now part of our venture group. And right now, for the last 18 months or so, very excited to be part of IBM Watson's strategist on the venture team. So in this role, we work with the top tier VCs in the community across the globe really. work with their portfolio companies specifically, align them, calibrate them against the criteria of being a Watson partner. And germane to this panel is we also have an additional instrument as part of the Watson ecosystem strategy, which is a financial component. IBM has set aside $100 million for direct investments in partners that have compelling Watson use cases and are building applications in spaces that IBM will not be directly building out.
Hi everyone, I'm Tarun Kalra. I'm from Next World Capital. We are a Series B to Series D venture capital investor, invest between $3 and $15 million across, broadly speaking, enterprise IT. I would say a couple years ago, I was sitting at a panel and Paul Moritz was speaking, and people were asking, why would you leave VMware? Why would you move to Pivotal Labs? He brought up a fairly germane point. He obviously has a broader purview of the life cycle of technology than I do, so he will learn from a man who's seen a little bit more of the wave. He said, for 2 decades, technology has been used to automate manual processes. You've seen this time and time again. You take manual processes, you move them to a technology process-driven underbelly, and you see all sorts of automations and benefits from that. And we're beginning a new curve, and that curve is leveraging technology not to automate what was already there manually, but moving to a world of new insights, new possibilities, new business models, the unknown, and we're leveraging technology to do that. And I think when you think about Next World, our fund, kind of our driving focus, is to look at these mega trends, these macro trends across disruption, and technology really being kind of an underbelly of that. And so broad verticals, big data, of course, we have a number of companies in our portfolio around that. Software as a service and cloud computing, virtualization, next generation infrastructure. These are all areas where we spend a lot of our time looking at these tectonic shifts from a world of technology being kind of a Gen 1.0 of automation, really to a world of enabling a next layer of disruption and competitive advantage for the broader enterprise.
Tarun, thanks for the exhaustive overview. Bring me to the first opening question, and that is, what's driving the market disruption in the big data space? And what business models are VCs looking at in terms of being most interesting and also enabling this disruption?
So I'll take a shot at it. I mean, big data is pretty much underlying every investor presentation we see these days, right? So it's hard to define it necessarily as a category. I think what we're looking at is we have these massive platform shifts in the market today, to cloud and mobile, and with a new assumption that entrepreneurs are able to build against, which is that you have massive distributed data sets that no longer reside captive to IT and captive to the business data scientist world. And I think with that assumption, it frees up a ton of opportunity to go build new solutions which can be delivered, different approaches. And what's a great opportunity for a lot of the entrepreneurs we work with is for the first time being able to sell directly to the line of business and the marketing department and avoid selling through IT entirely as you bring these technologies to market, which is really fun and great because the incumbents no longer have that entrenched competitive advantage.
I want to jump in here for a moment since you talked about expanding beyond selling to IT. So historically, clearly IBM has been a big player in data. Data platforms is our legacy all the way from a relational database back in the 60s and 70s. We continue to see that and we continue to believe, and if you've seen Ginny Domeni's remarks, data is the new natural resource. We continue to see sort of the power of these higher value insights that IBM is able to deliver for our clients. And so there's this ever increasing shift of data being the new sort of the monetizable asset and the infrastructure around the data that we have to put in place such that our clients, particularly I want to add to your comment on the line of business, historically we've primarily served the CIO, and increasingly we are seeing the budget shift from the CIO to other line of business owners.
You asked what's driving it. I'll start with a story. When I was at IBM, yeah, thank you. When I was at IBM, one of the sales situation that I had was to sell a data warehouse to a large financial service organization, an institution in New York, and the price tag, software, hardware, software, and services was $90 million. Okay, and it was a fun meeting, serious meetings actually. And today, I mean, that financial institution is still one that I have close ties with because I sold them that. And they're doing something equivalent to what we were selling them in the late 90s, and it's costing them about $2 million. So what is driving a lot of that, first of all, is this tremendous decrease in the broadly infrastructure costs, right? The second thing is that because there's this tremendous decrease in the infrastructure, they're letting their imagination run wild in terms of what can we do now that with this data, now that it's much cheaper to move it around, to store it, to manage it, and because there is so much more data that is available, both first-party, second-party, third-party data, and so much data that's being digitized today from the get-go, that's producing a very large number of potential use cases. So the trick that we're seeing right now is to move from I have X gazillion of terabytes of data to actually saying I have this much of usable data for this particular use case and do something with it. So again, what's driving it is the low cost of infrastructure, the large amount of available data, the imagination limits of what we can do with that data, and then what is limiting it is taking all of that and putting it to real work.
Right, so just to expand on what Evangelos was saying, if you think in the big data ecosystem, big data is nothing new. I mean, the largest enterprises of the last 30 years, Amazon's, Google's, Dell's, GE's, I mean, all of these companies leverage data, have built proprietary technology stacks to gain competitive advantages versus their peers, whether it's in the supply chain, whether it's in terms of competitive intelligence, insights and customers' feedback loops, whatever it may be. These sorts of technologies, limited from first generation big data technologies, if you will, limited, but also privy to just the largest organizations, the ones that can have 500 data scientists and spend the millions on top of millions to custom build technology stacks that would serve their specific needs. So big data, not new. The trend is it's exacerbated, and it's becoming more pronounced. I mean, just in terms, IDC sees data volumes growing at 45% year over year. In 2020, they see data, the amount of data on Earth that's 30x what it was in 2010. So that's the scale of growth that even the biggest companies can't build a temple any larger to be able to conduct analyses across a massive data set. The velocity of data is moving a lot quicker. You have more endpoints. You have faster networks. You have unstructured data being added on top of structured data. You have machines generating information. So there's not only more data, but it's going through pipes faster. People need to make decisions on it quicker. I mean, we saw the Michael Lewis book, I forgot, it just came out a few days ago, around algorithmic trading desks and making decisions on the fly in terms of building value on massive data sets in milliseconds, right? So faster data moving through pipes, making decisions on that data, and then the variety of data. You have unstructured and structured data. And so you have this amalgam of trends leading to heterogeneous, faster, and more data. How do we conduct analyses on them? The biggest companies, Google does it all in-house, Facebook does it all in-house. They leverage open source technologies, they customize this to build their own temples, if you will. But what we're seeing now is enabling factors, declining costs up and down the stack of compute. It's compute, it's storage, it's networks, all cheaper, all more powerful, parallelized computing, open source business models that open this up to much cheaper consumptions of these traditionally proprietary technologies, and on-demand computing, moving it to line of business. So you put this all together and you're moving the big data enabling factor from just the global 50 or chosen few to a much broader potential landscape of consumers of data products.
one of the other areas, we've talked a little bit about finance and broadly in terms of the opportunities within financial markets and enabling insight around financial transactions. So I had a question in terms of, maybe you can tell us a little bit about what's happening in the IBM temple, specifically around Watson, and maybe a little bit about the Welltok deal that you guys conducted recently.
Yeah, sure, happy to. So I think if we take a historical perspective, we really have not stayed away from direct investments as a strategy. There's a very simple reason for that. Our business, a $107 billion business as it is too diverse. So early days when we did experiment with such a direct investment fund, we found that some of our initial moves, for example, when we did something local to China, there were some specific investments that were relevant for that market, they were actually in conflict with other parts of the business, right? So from time to time, we found that because the portfolio is so broad, because we have such a broad, multifaceted strategy, a direct investment fund just didn't work for us. Okay, so we work more on the strategic partnering, or maybe from time to time some very targeted joint ventures. But now with Watson, I think we have a clear opportunity. So this is a next generation cognitive platform as we see it. I know, the word's out there, but at the essence of it, this is a question answering and a reasoning engine, a capability that can dialogue and reason over large amounts of unstructured information. And so the ecosystem is a critical part of this technology, of our strategy for this business. And so this direct investment fund of $100 million is being specifically set aside to catalyze this ecosystem, stand up the first few partners. And specific to Welltok, our strategy is, it's primarily about strategic alignment, about those partners that are building Watson-powered applications in spaces that IBM directly doesn't, go build things in. Take Welltok, it's a social health, social wellness management company. It's an application. IBM's never going to go build those sorts of applications as some of the early other partners that you see. So the investment, I would say, to just appropriately calibrate that, it's yet another component, it's another instrument we have in order to launch this ecosystem. The primary driving force is not the IRR, which does not mean to say we don't look at the financial returns, but it's really to make that strategic statement saying IBM is behind this. We are committing dollars as well as in-kind resources to making this partner successful.
So about dollars, last week we had two significant deals in the space. We had Cloudera, the $740 million raise, Hortonworks, $100 million raise. Hortonworks is looking to IPO next year, at least their CEO is on record. Cloudera, their CEO said they'd like to be a $20 billion company in terms of valuation over the next few years. Jim, question, do you think, first of all, do you think these valuations, these future valuations are pie in the sky? And secondly, from Jasco's perspective, what is a typical time horizon do you think it would take to reach these kinds of valuations in today's marketplace?
Well, certainly there's premium being placed on category winners these days, but I think there's massive economic shifting in these platforms, and I think both Cloudera and Hortonworks and maybe lesser degree Mapr, you have massive open platforms that allow a ton of new development for low cost for new application and enterprise application development. It's a huge platform shift, and I think we're going to see the market cap of the traditional incumbents in a sense, but moving over to this new class of companies that are able to serve the modern open software development environment, and that transfer of wealth, it's getting ahead of itself to some degree, but that opportunity is there for them to capitalize on. We invest as a Series B investor with an assumption that we're catching companies that already have a product in market, evidence that they can become a category leader, and so we assume it's sort of a 5 to 7 year window to where we can get to an outsized return. But strategic transactions happen along the way. I mean, Aster got bought before it had a chance to really build out their vision on SQL MapReduce integration. It was a fantastic outcome for us, so we sold a little bit early there. But we sort of have that 5 to 7 year horizon, and we've been fortunate. We've had, in our 10 years, we've had 4 companies go public, $1 billion plus market cap. We've sold a couple more into that range, and we've sold 20 of our 60 companies, and positive outcomes already. So it's a very vibrant market. I think what's fantastic about this market is, in addition to these new entrants and kind of new middle-tier companies like some of our portfolio companies, FireEye, Palo Alto, are now going to be the next wave of aggressive acquirers that are going to leverage that currency and that rapid growth to go build out what they're doing. I think what Mark's doing at Facebook is fantastic. I mean, whether or not those are the right assets, nobody else in the world can pay those prices. He's assembling tremendous talent, right? So if those platforms happen, they're going to win. And but I think we're witnessing, in our careers in venture, you always want to see a platform shift. Right now, there are 2, arguably 3, if you want the whole data ecosystem in there, which is why it's just a phenomenal time to be at a startup.
Let me add to what Jeff is saying here. I think the reason that you're seeing this kind of numbers, both investment size and the associated valuation, is because I think large corporations, whether it is IT incumbents or other type of corporations, are seeing a lot of disruptions happening, driven by information technology for the most part, and they're finding themselves behind the 8 ball, as they say. So just to take Intel as an example, Intel missed the mobile trend by a big margin, and they want to make sure that they do not miss, actually I would say, they've also missed mostly the data trend as well. They had their own distribution, didn't go anywhere. And I think what you're seeing with this move that they made, their admission that they're coming late, but they need to participate. And I think you will find this going forward in many other spaces where large, again, whether it is in the pharma industry, in the auto industry, in the agriculture industry, the logistics industry, that the large corporations cannot keep up with the amount of disruptive innovation that is happening in their fields. And this is not just something incremental where they say, okay, I'm going to go do a tuck-in acquisition and I will move forward. These are really fundamental shifts. I will close by saying, if you look at 2 acquisitions that Monsanto and John Deere did, they were both big data acquisitions, right? And these are, one is an agricultural company, Monsanto. John Deere is a manufacturer, heavy equipment manufacturer, and they both acquire companies relating to data, relating to IT, because they see how this area is disrupting their day-to-day business. So, these big values, these big prices are associated with that admission more than anything else.
Just to layer on, the valuations you see in some of these companies, I mean, you can't really base it on precedents. I mean, we look at precedents in terms of exit values, in terms of entry values, and it's tough to be able to put numbers out, especially as you get to kind of the later stages of deals where you have strategic investors building up prices. But as you look, kind of, people talk about bubbles today, and we know the data market. What is BI? 15 billion. The warehousing alone, another 12 to 15 billion. The services are 5x that in terms of annual spend. MVC with the on-demand computing model. Now we have intelligence and analytics going to line of business that was never part of really the BI budget before. It was all kind of IT spend, IT managed, and you had data scientists working on top of these stacks. So we see a potential avenue of 2 things. The pie potentially being disrupted by cheaper, they are generally cheaper solutions, but also disruptive paradigm shifting solutions, and then a move to the line of business that potentially could expand the pie to multiples of what it is today. But when you think about the size of potential opportunity, I mean, the world is moving faster today. As Evangelos and Jeff said, you have disruptions across multiple vectors now, where platform vendors are increasingly, as they have acquired many more companies, slower to be able to react to these. And I think think the guiding trend is the world is fundamentally bigger. You know, and you have more and more companies embracing technology. It's no longer kind of a Fortune 50, Global 500, Global 2000, up and down kind of the pie of enterprise sizes. People are embracing technology as a way to leverage competitive advantage, as well as build automations and efficiencies in their business models. And so when we think about the size of the opportunity versus the now sheer amount of players who will bid up to buy companies today versus 10, 20 years ago, you can at least base it or ground it in some sort of reality. The multiples, I really can't answer that because they're high.
So is there future multiple expansion, or are we cresting at a bubble or near a bubble? It sounds like we're still trending up in multiples.
Are you asking whether we're 96 or 99?
Your crystal ball.
Well, hopefully not 2000, but
Hard to forecast. We don't have data. For all of you entrepreneurs and aspiring entrepreneurs, the pendulum shifts in different markets. Right now, the power is on the entrepreneur side. So if you have a good idea, if you can solve a business problem, go do it. It's about as good a time as there is to launch a new company. There's a ton of capital. It's cheap to build these companies. You can drive a huge return in a relatively short time frame. It's an awesome environment.
But also, Jeff said something before, which I think is important to dwell on. In the past, if you look at technology waves in the past, they tended to be dominated by a single technology, client server, NPR computing, whatever, disk drives. This is the first time, maybe ever, where you have multiple waves driven by these mega trends, mega technologies that are coming at us at the same time. So maybe even if we are in a bubble condition, maybe we should not be thinking about it. At least I should say we are not thinking about it as a single bubble, but maybe a series of, or a collection of bubbles, not a series, but a collection of bubbles. And it may be that's the risk of being in our business, right? It may be that some of them will burst. But because there are so many of them happening simultaneously, I'll go again with something that Jeff said. This is really a good time, both if you're an entrepreneur to start something, but also if you're an investor, because you can diversify much better, even if you are just in IT. In the past, venture firms used to diversify by going to other sectors. Like in my previous firm, we used to do retail, biotech, healthcare, and that was our form of diversification. Now you can stay within IT and diversify because there are so many big markets that can be created or that are being created.
Tarun, do you guys want to, in terms of, is there a bubble that's forming or about to pop?
Let me, while you ponder that, let me give you a kind of respond to the incumbent statement and the bubble, right? I think definitely there's an increasing awareness in incumbents like IBM about these multifaceted, multiple bubble disruption that's happening on the outside. So I think as a culture, I think there's awareness and recognition for the need to work more closely with a non-oil blue stack. I mean, traditionally, I would say even 10, 15 years ago, maybe even 12 years ago, partners usually, when they came on board IBM platforms, it had to be an oil blue stack. We were constant, and we had our ecosystems teams looking for ways by which we could influence partners to integrate on increasingly blue, a blue stack. That's no longer true. There's a clear awareness that the world wants to live in this heterogeneous environment. We see it in our client base. Just a reference point, strategic outsourcing is a very big part of IBM's business. It is not something that you hear about a lot. This is a $22 billion business. This is where IBM will go in and take over the IT infrastructures, manage it for the Bank of America, the Kaisers, the largest state farms of the world. And we have thousands of people dedicated to managing the IT infrastructure of these clients. What we are finding is our customers, our sort of big, customers that we've known for decades, now want to run their stuff on Amazon, on Redshift, on Tableau, right? So they've got a very totally heterogeneous stack. So we have sort of really full cognizance of this environment that our clients are shifting to. So definitely from our point, our response is to have a more open, agile approach in terms of being, acknowledging these shifts in the industry, bubble or not, but the fact that our clients are embracing these trends and being more ready to be their trusted IT partner in their journey.
I mean, if you look at the historical trends, other than the 2000 bubble where we had multiples that were based on users versus revenue, and you look at kind of revenue multiples today, they can't stand up. Well, historically they're at all-time highs, and if you just do the math of revenue times multiples and you project out to revenue 10 years from now, it's bigger than the GDP of the earth by X times over, right? So you can't assume that, I don't know what someone do the math, but we can have that conversation, but you can't assume that multiples will stay at this level. We're not in the public markets. You can talk to a money manager about what they think. I think they would tell you to de-risk your exposure to equities, talking to some of them. But overall, you can't assume that multiples stay at these levels over the long term because they're not historical. They're not in touch with historical means or even standard deviations of those means. But going back, I think we have rational individuals building these multiples, and you have to think once again about what's happening today. Fundamental disruptions of very large markets that are growing ever larger, with companies now that have more consumers of the technology than ever before, and you have growth rates that are much faster than we've seen in the past. So, while there's clearly, I'm not going to say bubble, but unsustainable multiples over the long term, there are pockets of value being created over the middle term that can sustain themselves because of their growth rates, because of the fundamental disruptions they're doing against established vendors. And so I would say, if I was going to put a high value term out there, I would say pick your spots versus picking the whole market, if I was looking at it today.
That's a very good point in terms of picking your spots. So our format's going to be a little bit different today. We're going to pause here and ask the audience if you have any questions about the market or what these folks are seeing in terms of deals or any questions relating to venture finance. And once we close those questions, we're going to dive into specific startup, entrepreneur-related questions or dialogue around that. So are there any questions from the audience in terms of if you could come up close or shout out the question, try to repeat it?
What do you think of the Alibaba IPO coming up in New York City?
Is it still New York or Hong
Can you
Kong?
repeat the question, please?
So what do you think of the Alibaba IPO in New York?
I don't have a lot of insight. We focus strictly on U.S. investments, but I think it's the Netscape moment for China's big commerce internet company. It's going to be massive. This is a powerful business.
Yeah, I'm just wondering what it means, though, just in terms of opportunity, based on the size of their data.
Well, I think it's another massive acquirer in the market. We're actually seeing that right now. A lot of strategic activity coming from the big battle going on between powerhouses coming out of China. Those are very global businesses by the nature of them. And China has less stringent privacy laws and collection of data, so they know an awful lot about their consumers. So I assume those are going to be massively powerful companies coming over here. I think it is interesting that they're filing here and listing here. I think it's just further signs of the opportunity and strength of the U.S. economy.
Another question here. How is crowdfunding going to change this whole gap? I mean, that's getting more and more crowdfunding model. How is that going to change when that is done?
So let me replay that. How is the crowdfunding model going to change the VC model or impact the VC model?
Well, so we are, I think at the very early stage investments, we see a lot, I would say the firms that are doing early stage investments are already seeing a lot more competition than they ever did before, because it's good for entrepreneurs, obviously, because they have more options for getting that initial funding. Okay? But I've been an entrepreneur twice, both times venture-backed entrepreneur. I would say that the entrepreneurs, I think, that the only thing that VCs offer is money are really A, naive, and B, not the kind of people that we typically work with because they tend to be very difficult. So there's a lot of value that good VCs offer, ranging from good knowledge about the market that the entrepreneur is going into, even when that market is relatively new, to various types of networks, whether it is employee/executive networks, advisory networks, partner networks, customer networks, all of which are make up what ultimately big companies becomes. I mean, you cannot build a Cloudera through crowdfunding, but you can get it started. Okay, but again, so that's why I said that at the very early stages, between the various sources now of available capital and the lower cost of whether it is software or other resources to get a product going, to get a company going, the entrepreneur is having many more options and many more opportunities than they ever had. I mean, I did my second company in 1998, and to get to version 1 of the product cost me maybe around $6 million, and I know I could do that the same thing now with $1.5 million. Okay, but I would say that to build the kind of company that I built, it will probably take more money now than it did then.
Yeah, I'd agree with that. And I've been investing now for about 15 years, and I've seen the rise and fall in a couple markets. And I think when things get frothy, you see a lot of angel investors, you see a lot of corporate investors. They both usually don't last. So sustaining a company through the cycles, all of the successful companies we've had have raised 50, 60 million across 3-4 rounds. It's awfully hard to go back to your crowdsourced, angels 4 times and ask them to double up that investment every time, right? So, right, unless you have a lot of friends or a really good public sales deck, that's a tough feat to pull off.
So, we can talk about crowdfunding and what that means, but in terms of the value that a venture investor will provide, it's that stable capital source over years, the good times and the bad times, providing the networks that they've built and the networks of their firm that they've built over the course of their time. But also it's that muscle memory of what it takes to build a company. What kind of metrics are you looking at when you make certain strategic decisions, when you expand internationally, when you open up that second office, right? It's also that experience set that they've lived through, but also have seen across their companies who have failed and succeeded. Crowdfunding, we're seeing it come up more at the earlier stages. It becomes a little more difficult, to crowdfund a later stage because specifically some of the benefits that a single person provides. Think about it at the board level when you have to make decisions. How would a crowdfunding model work at a Series C stage when you're adding one person to the board? It seems difficult. I'm not saying it's not possible. I've not seen it yet permeate the upper ranks of investing beyond the seed stage. Once that starts happening, then let's reformulate costs. But today it seems difficult for me to move beyond where it is, which is at that point of kind of at that start of innovation cycle for a company.
Just to add to that, I think, again, from sort of the IBM venture ecosystem perspective, crowdfunding is just sort of yet another instrument, yet another source to seed those early stage companies. We typically do not engage at that stage, but the larger the pool, the higher the percentage that'll shift into Series A, Series B, where we see that they have some sustainability and enduring that.
Thank you. Question in the back.
This is a question that what you're a generic one. You touched on it briefly, but the Intel investment in Cloudera earlier this week, I think it's the single biggest good investment Intel's ever made. What does that mean? And then more broadly, is there a shift to, maybe you don't want to answer this, but is there a shift to more strategic investment by companies in startups? Clearly, some of the big companies don't move as fast as some of the smaller, more nimble companies in technology innovation. But even in terms of acquisition, if the multiples are so high, to your point, that it doesn't make financial sense today to try to acquire Cloudera, for example, and those inflated multiples. Are those companies, the big companies, the SAPs, the IBMs, the Intels of the world, Microsoft, going to make more strategic investments in smaller companies as they're weighing it in?
Have you seen the balance sheets of large companies recently?
They're huge.
They can do a lot of acquisitions and make up for a lot of mistakes of the past. So I'm not that worried about whether they will or not continue making acquisitions. I think they will. To your other point about corporate investing, I agree with Jeff that it is a sign of the times in the sense of all the time you have corporate investors coming in. I think there's a big difference though between what we saw in the late 90s and what we're seeing now. And I talked to a lot of corporates. In the late 90s, when corporate VCs made their appearance here, a lot of the motivation was financial. They were saying, I'm helping a company, I'm partnering with a company, I'm helping them to do X. Why can't I participate in the upside? Right? So they were making a lot of investments, and I know several corporations that had created funds back in that time with the explicit, with financial goals very similar to ours, believe it or not, but with very different personnel. So that was an interesting experience. This time around, I hear more corporations. I mean, there's still corporations that are talking about having producing financial returns from their investments, but a lot more corporations are making these investments as a means of business development, kind of like what IBM was talking about. Because again, they're finding either because they want to seed an ecosystem, very much like IBM does, or because they're recognizing that they're falling further and further behind in innovation, in disruptive innovation. So they're looking at the R&D organizations as being able to only provide them with sustained innovation. And they're looking at what's happening around here and is giving disruptive innovation, and so they're asking how can I participate there, and they're looking at those funds to do so.
Intel specifically did investment in.
To me, Intel is a separate category. I think to me, Intel, the size of the investments I mentioned before, is an indication that they do not want to see down to them what they had with, what they missed with mobility. Okay, so they believe that big data, and since they're attacking the data center now, they believe that big data will be a major contributor to that, and they're looking at it, they're making an investment very similar to what they had done to Windows back in the 80s, right? So it's to me, so it's not so much also only a recognition of innovation, but it's also a recognition that they are losing in certain markets, and they need to make a big play.
Yeah, I mean, I don't have a lot of insight into it, but I would view that as a fairly desperate move, right? They completely whiffed the whole mobile ecosystem, and you can stretch, but really the cloud and virtualization would not be good for Intel's business, right? Cloudera has been public, they have 300 customers. So Intel paid over $2 million per customer to get into that company.
Twice the valuation was a week before.
Yeah, I mean, that's pretty desperate, right? So, and the thing is for the startups now, we talked about how there's a ton of capital at the seed stage, there's also a ton of capital at the later stage. If you have a proven model that's working, there's endless sources of capital right now. So the only reason to take corporate dollars is if it's a win-win scenario. And that's why it's a little bit harder. They're gonna have to do something that massive and that outsized to compete against going and raising money from T. Rowe or whatever some of these later stage investors are. So I think the big companies should and need to do this and have access to the talent and these new platform shifts. But it's not that easy for them either, just because there's so much capital out there.
And just saying from the other point of view, like, so Intel, their motivations. What about what this means for Hadoop? I remember speaking to Michaels, I think he's the former CEO now, Cloudera, but the former CEO of Cloudera, I think, still kind of running something. But 07, 06, 08, when Cloudera's version of Series A funded, I think the benchmark did their Series A at that time. But speaking in 7 years ago, 8 years ago, what the conversations were, I'm really the bastion of it, right? I mean, you think Cloudera is kind of being kind of that foundational member of what Hadoop needs today. Every platform company now has a play in Hadoop. This investment, forget the valuation, but the sheer amount of it, it talks to kind of where Hadoop has come over the last 5 years. We have an investment in Hadoop. We probably have another one coming shortly at the secondary layers of how you manage, how you secure, how do you now build business value on top of it. But as a foundational layer serving as that data warehouse, we're seeing a very clear trend of enterprises first moving and saying, you know what, 3 years ago, let's throw unstructured data into Hadoop because it's cheaper than everything else. I don't have to put in Teradata, and I'll figure out what to do later. And we're getting to that point now in the trend where it's no longer later. It's now we have all this data, it's cheap, and I find business value from it. And we're seeing a host of startups, and the amount of startups that are being built around the Hadoop ecosystem, security, line of business, analytics, visualizations on top of it, management features, 50, 100. And so it's
that was my question, how many?
It's a 50 plus in different angles of it. It's a massive ecosystem. The Cloudera and WorkMerce are taking that data warehousing there, the $15 billion market we talked about. They'll move up, but they will inherently not be able to move up fast enough as startups that are just trying specifically that, because they still have a lot to conquer in making Hadoop more real time, or it's still trying to become near time. Making it more near time to real time to take some of the operational database use cases. And then beyond that, we're still very immature in the hardening of Hadoop. There's a lot that has to be done. We talked about this about the cloud a decade ago, and now we're still trying to harden the cloud, public clouds, private clouds. We're still at kind of the middle innings of doing that for Hadoop to put into production use cases for enterprises. So a lot to do.
Intel just accelerates the transfer of value from the Teradata to the world to the platforms, or what is the Intel investigation?
I mean, what is pivotal, right? I mean, that's EMC and VMware building something that do very similar. So it just legitimizes from the slow-moving platform companies that this is very disruptive, this is taking share, and it's not going to be a bubble that bursts. Maybe it shrinks and then regrows, but it's something very real.
It goes to the entire trend of the redesign of the data center. Right? If there's a new set of technologies, SDN or whatever, that's coming to this new data center, and data management is going to be one of them, right? So that's the bet.
Patrice Horowitz just recently raised $1.5 billion based on demand. What do you think that's signaling for you as VC as to how the landscape is changing for US investors? Because they typically invest in seed in the United States funds. So what's that?
So let me repeat real quick for the audience. So Andreessen Horowitz raised $1.5 billion last week. What is the impact of the raise to the early stage investments and to the venture community at large?
I shall say that Andreessen Horowitz, like many other firms, is no longer an early stage firm only. Okay, there are a number of firms, and being one of them, that have moved from being VCs to being asset allocators. So that means that they take a pool of capital from an LP, and they can decide how much to put in a seed stage set of investments, how much to do late stage, how much to do very late stage, and everything in between. They're not alone. I mean, you look at somebody like Insight Capital doing something similar. You look at NEA doing something similar. Sequoia has a family of funds. I mean, so I think you're seeing the clustering, I call it, of the venture ecosystem. From some investors that are specialists, whether it is early stage, whether it is late stage, whether it is industry specific. You have a company like Emergence that specializes in cloud-based investments, and everything in between, right?
Do you think they're basically just spreading risk? Spread risk profile?
Well, I think they have a stated objective of trying to be in every company they can get into. What is if they're spreading the risk, or what is their strategy? None of us work there, but what they've stated, I think they're trying to get into a great company or whatever state. But bad behavior in our industry is when things are frothy, we go raise too much money, right? You raise these massive funds, and there's a challenge with that is just the nature of managing investments and projects if you invest 100 million in one company, you invest 3 million in another company, you're not going to spend any time with a company with 3 million.
We work with Andreessen Horowitz quite closely, and I would say, I don't know what the mechanics are, I don't have insight into how they partition, but they definitely have a clear seed stage allocation, right, and we have access to those, and the venture stage, the late stage, not late stage. And we find actually that the pipeline of companies beyond seed are very promising. They're in highly aligned areas for IBM. And while we have nothing explicit going on right now with Andreessen, to your point on Welltop, that was syndicated with NEA and Emergence and Interwest Capital and Qualcomm, some other corporates as well. So as we continue to make our investments with this Watson Fund, we will be continuing to look to syndicate with these tier 1 VCs.
Great answers. Any other questions before we go? We have about 10 minutes. We can talk about the early stage and the entrepreneurial life. Any other questions before we jump into that?
Tarun, you mentioned that a lot of new investment now is a little higher up on the basic customer base. I was looking at manageability layer in particular, and I just keyed on your comment. How would you characterize, where that area of maybe security and resiliencies are in terms of unmet needs?
Are you speaking specifically in terms of big data and the Hadoop ecosystem?
Yeah.
Or broadly speaking?
Well, both. I'm looking mostly at Hadoop right now, see what, if there are unmet markets.
So two broad, areas. As a venture investor, as an innovator, you're probably not going to build the next Hadoop distro, right? I mean, you have 3 big vendors. If you contemplate a fourth one, or not bar, the fourth one, you have 4 at least, maybe more. So where's the value being built? And there's various places. Hadoop as a service, I think, providing it. For example, you saw what Splunk was doing, right? And in terms of bringing order and project management and searchability to this massive amount of machine data. Then you see Splunk in the cloud, Sumo Logic, right? Bringing it as a service to the mid-market. We're seeing now, with the distros, now we're seeing 5 or so, maybe more, 5 that I know of, startups trying to build Hadoop as a service. So that's one interesting area. One very interesting area is now productizing it in terms of vertically specific or line of business specific applications. You've seen, we're in a company called Datamere, which is business intelligence on top of Hadoop. Very clear what they do, but they enable enterprise almost as a chalkboard through the tools to build themselves. What about providing, for marketing, Hadoop-based predictive analytics, right? Or for the sales guy, what 10 contacts should they contact because these are the guys who are going to turn this new information. There's an enormous amount of information. So line of business focus, intelligence and analytics is somewhere that I'm spending a lot of my time. In terms of management, as we talked about, we're moving now. This is really only for more than just kind of batching of 10 to 20 companies, or 50 companies or 100 companies, to the mainstream of really putting analytics on top of Hadoop. I know Datamere is kind of a barometer for it, right? And you see Cardinalsphere, Platform, Adapt. There's a number of companies that are trying to come out in this ecosystem, and you see what the growth curves look like for them. And moving from, hey, what is this Hadoop? Let's build a node over in the side, cluster over in the side, and put some unstructured data on it. To actually building analytics and intelligence and business value on top of it. And to do that, we're noticing a number of problems, right? How do you make Hadoop consistent? It's a big issue. Consistency from one search to another when you're doing the queries, it's a big problem, and we're not there yet. How do you utilize your processor for these massively intensive queries? Hadoop is very processor intensive. We need to make that lighter and more efficient. And there's all these programming languages, Pig, Hive, there's cascading, there's 10 other things coming out today. They're trying to figure out how to optimize the memory usage and the CPU usage on top of Hadoop. Just the security, you have data in motion moving through all these different places. We talked to the people at platform security companies, the IPO security company over the last 2 years, and they don't have a Hadoop story yet, and it's a pain point in the enterprise. So there's a couple places.
I'd say overall as a trend, the whole IT operations opportunity is massive. It's a really crummy time to be an IT person. right? I mean, not only do these kids come to work now, and you no longer get to give them a BlackBerry and a ThinkPad, they bring their own device, they've already signed up for a bunch of apps, they're bringing their old company's materials with them, which you're now responsible for, bring all their personal stuff with them. When you fire them, you have to give them some of that stuff back, right? That's the way to build morale in the company is start wiping away baby pictures when somebody leaves, right? So you have that whole challenge. Then on top of it, Emmanuel's point that when companies don't own their data center anymore, that's a huge change, difference. When somebody comes to yell at you that the application uptime is down or is slow, you don't own those assets anymore. You have a dynamic data center that's running a virtualized environment with maybe stuff bursting out to the cloud. That's pretty hard. And so those old framework companies, another area we think is completely going away. And so you have a whole new stack of everything from what does network management mean when everything's running in the cloud, right? And you no longer have a perimeter. What does security mean? What's access control if you don't have a hard core anymore, right?
Just want to add to that. So that kind of environment is exactly one of the, a big part of what one of our lines of businesses manage, these heterogeneous environments. So to your point, I think about what's next if the platform to do this, stabilize where's the value going. I would say, again, talking from the point of view of a perspective of a trusted SI, if that's one of the characteristics, how you might characterize IBM for our classic enterprise clients. We really see it as a kind of an information journey. Sure, Hadoop is running, but guess what? They've got the systems of record, all the ERP systems running in traditional data warehouse and traditional relational database. They've got their systems of engagement running all over the place, running in the cloud, in a very heterogeneous environment. Plus, they've got a whole series, everything in between, your master data management, how about your analytics platforms, your Cognos, your SPSS, and the plethora of analytics capabilities there. And many of them are running something on on Redshift, on Tableau, and they're mixing and matching. In particular, we see the CMOs will push these systems of engagement applications outside the firewall, right? The CIOs will run more of their stuff inside the firewall. It leads to an extremely complex and dynamic sort of environment that IBM is typically managing, trying to inject some of these IT operations as a service tools.
And by the way, since we are in the big data conference panel, all of this, every layer in this new stack is producing a lot of data. And the only way to start thinking holistically about how do I deal with uptime, how do I make the virtual CIO's job a little easier, is by capturing and analyzing the hell out of that data. That's why companies like New Relic and Splunk and doing as well as they are.
One place that we haven't touched on that I'm spending a lot of time is the machine learning and predictive analytics space. You see what Palantir's been doing for the last 5-7 years, almost as a technology-enabled consultancy or SI in a lot of ways. In terms of the link analysis and the hotspotting and the trend spotting, the clustering. These are areas where you have to leverage machines to supplement and accentuate what we can do as individuals in terms of providing insights. And we're seeing today leveraging various approaches and clearly big data stacks with all sorts of heterogeneous flavors, alphabet soup of productized solutions, both as a broad enablement tool, and if you want, we can talk about it later, as a broader enablement tool, or for specific use cases, recommendations. This is kind of a classic early stage example, where we saw Amazon building their own big data stack to figure out, okay, you did this, like-minded individuals have done something similar, and then 3 steps later they did Y, right? So provide those recommendations. 5 years ago, they were productized for everyone beyond Amazon to be able to do. And that's just a very broad use case. And now we're talking about creators. We talk about weather. You brought up the climate corporation, and the AVAC company. That's clearly what they did. These vertical, very focused use cases. We're going to see, and we are seeing, a number of big data stacks that could be used if you thought about a purpose for 20, 50 different things. You're focused on one high-value use case, and you have $1 million active. And and there's a lot of value to be created there for very focused use cases. Where you see the pain point big enough, the disruption to the value creation big enough, and the amount of buyers at a certain price point wide enough that you can build a $150 million company, you can see these sorts of exits then.
Yeah, I think it's a really good point. I mean, for those of you guys thinking about new businesses or positioning yours, solve big problems, right? The world doesn't need more data. The world needs problem solve leveraging data. Right? It's predictive analytics, leveraging collective intelligence to solve problems in different vertical and horizontal use cases overall.
So closing question in terms of, we didn't have a chance to talk about the entrepreneurial piece, but one quick question with a quick answer from all the panelists. What do you think in terms of what the best sources of capital are today in today's market for an early stage idea or a more early stage kind of company? Where are those opportunities for those innovators?
I would say that there is still a little value to get out of venture investors. You need to get to know, you need to establish a good rapport with them. You need to understand why you're approaching a particular investor and what that investor will provide to you and to your venture. Then you may be able to supplement that with other sources of capital, whether it is individuals, whether it's a crowd or friends or family, or through corporate investors at the right stage. But I still believe that there is tremendous value that entrepreneurs get from working with the right VCs.
Of course, we have bias there. But yeah, start with angels. They call them angels for a reason, right? So to help you get started without a lot of overhead. But it's a pretty well proven path to getting companies launched and funded. I don't think that's an area that necessarily needs to be disrupted. I think starting with solving big problems, finding great people. Don't lower the bar on the first dozen people you hire for your company is the most important thing. Hire the best people you can get, because once you start to drop that bar, it starts to deteriorate quickly. So go hire great people, have a great idea, and figure out lots of ways to get funded.
Quick sidebar question. Are there angel networks or groups focused around big data that you're aware of?
There are specific like seed funds, like Data Collective and IA Ventures that are specifically set up. I mean, a lot of venture funds have. But there are some dedicated funds there. But again, there's no active venture fund that's not looking at something data related at this point.
And I would say on the earlier stage side, you have more and more of the funds or the clubs or the bands, or the incubators that are available. There weren't as many of them 5-6 years ago. So it depends. The source of capital at different stages of companies are different. But at the early stage, you do have a much wider network if you're plugged in. I will say anywhere you look for capital, up and down, kind of the supply available, finding more introductions, I think is the best way. We all get a lot of emails, and if you find a way to be introduced by someone else that knows me, knows my brethren here. I think that increases the chance of that first meeting, and from there is pitching your idea for yourself.
I do have one direct response to your question that a couple of dedicated early stage big data companies, investors, Southern California, Frost Partners, Venture Partners, and SUSE. Very exciting. We stay connected with them because they serve as a pipeline. Don't come to IBM Watson Fund for your early stage big data investment. But I think some of these have very targeted investments in that space, and we work closely with them because they're partners.
Thank you. I want to thank the panelists for some great dialogue today. Round of applause.